Hey, it's Keith again. I'm here with Miranda. Miranda's one of our financial advisors. She keeps sticking around here fighting the good fight for you. We wanted to come to you today and talk a little bit about the interest rate environment because it has a real impact as we talk to retirees, particularly as they look at bucket one for things that they have their save and spend account. Interest rates are going to essentially, in many cases, close to zero.
That's right.
And that's really a function of the federal government is really, through the Federal Reserve, is driving interest rates down to close to zero with an attempt to kind of stimulate businesses.
Sure.
Miranda and I were talking about to get them out, reduce their borrowing cost, and prime the pump for businesses out there. So, but with all that, I think people understand interest rates are going down. They certainly get that, but that leaves us with a question. Is now what?
Yeah.
You know, now what do I do with money that I had in CDs? They're maturing. Now what? Should I look for alternatives other than CDs? Particularly I think, Miranda, people are asking about their bucket two money that are retired. Where can I get some return for that? And the tool set that I wanted to bring up and visit with you about that I know you talk to clients about, and there's a lot of misconceptions about it, is the terminology of a fixed index annuity. So can you kind of go over the basics of that for folks who maybe have heard the term or have confused those with other annuity types?
Sure. So a fixed index annuity, I like them simply because they are fixed in the fashion your principal doesn't reduce unless you were to use the principal. So the performance or the rate in which it earns is typically based on the performance of a particular index. Oftentimes we use the S&P 500 and we get a percentage of the upside. So for an example, the one we were discussing this morning, if the market is up 10, 20%, you would get 40 to 42% of that growth.
So going back to that to make it as an example, if the market rebounds, is the market like an index like S&P in this general example? If that index went up by 10%, they would get a 4% interest credit.
That's right.
If it went up 20%, they'd get an 8% interest credit, which may sound like a lot or a little bit based on getting a 0.5% on a CD or 1% on a CD.
Currently.
Could be really good.
Oh, absolutely.
What's the worst case a lot of times with those fixed index annuities? Could you describe that?
The worst case scenario is maybe you don't earn anything on an annual crediting basis, or maybe you earn a minimum of 1% in some cases.
Yeah, so it depends on
it depends
product
on the
to product and what you choose. So obviously that becomes more appealing as interest rates are closer to zero.
Absolutely.
One thing I hear about, and I want to address, is a lot of folks hear annuities and they fees. So annuities, in the case that we utilize them, aren't these high expense rated fees that carry on year after year. They're much more of the CD alternative.
That's right.
So folks that are getting these big commissions and these salacious payments for using index annuities must be using something different than what we're using, because they can be much less expensive for clients, at least of what they're paying us, than, for example, like a managed money account. So do you also see folks that maybe use these because they don't want, not only they want to get a better rate than CDs, but they're also maybe afraid of mutual funds or those don't fit or stocks?
Oftentimes people, when they can't get those rates at CDs, your 1%, your 0.5%, then they turn to oftentimes your stocks, which are very risky and of course can go down and lose their principal. So
especially if not diversified appropriately or used in an appropriate strategy.
Absolutely. But they do go and seek of a better way of earning and participating in the market without that downside risk, which is oftentimes the fixed index annuities that we use.
Yeah. Well, we don't want to spend a lot of your time today, but obviously what we're continuing to survey and look at, and Miranda is daily, and I thought it was important to come to you today to talk about fixed income solutions in an environment where it's getting tougher for folks to just put money in a CD or a bond and expect it to earn something, or they're looking to manage risk. So there's always solutions out there. You've got to understand when you talk to your financial advisor, obviously how they're paid, what the problems are. I also want to end with the most common question I get is an annuity safe? And in the state that it's issued, Typically, and no matter which state you're living in, you need to research the state guarantee fund, and accordingly, they'll have a fund that supports that in the event of, God forbid, an insurance company collapsing, how the state supports or provides guarantees in the event of insurance companies collapse. That is important, although really rare. It's important to consider that. So options for folks in bucket 2, we think these can be a tool if used in an appropriate measure and amount. Secondly, they can provide an opportunity to really continue to keep your money safe in some way, but you got to use them in the right portion for liquidity, right?
Absolutely.
Not too much in the event that you need liquidity or access.
Absolutely. We follow strict guidelines on how much we do allow someone to put of their liquid net worth into these, just simply for that. And we make sure that they have ample access to what they do need.
So if they needed to buy a car or take advantage of another opportunity. Well, again, no one solution is right for everyone, but we want to continue to bring you education about the tool sets evolving literally day to day.
Sure.
Rates are moving pretty dramatically. So feel free to call us, call your advisor, think about how the tool set can be managed in a changing environment. We want to be a resource to you. So thank you.
Thank you.